Welcome to Charged Alpha. I'm Hudson, and with me is Lana. Today we are covering the full company chapter for Uber Technologies.
Before we get into the quarter, let's step back and understand what Uber actually is, how it makes money, and what drives its competitive position.
Uber was founded in San Francisco in 2009 by Travis Kalanick and Garrett Camp. The original idea was simple: request a black car from your phone. That idea reshaped urban transportation.
Today, Uber operates a two-sided marketplace connecting riders with drivers and restaurants with delivery couriers across more than 70 countries and 10,000 cities worldwide.
The mobility segment, ride-sharing, accounts for roughly 55% of gross bookings. It is the core of Uber's business and its highest margin operation.
Delivery, known as Uber Eats, represents about 40% of gross bookings. It has grown into one of the largest food delivery platforms globally, competing with DoorDash and local players.
The key metrics for Uber are not traditional revenue metrics. Monthly active platform consumers, gross bookings, and take rate tell you more about the health of the marketplace than top-line revenue.
Take rate is the share of gross bookings Uber retains after paying drivers and couriers. Mobility runs around 28%, delivery runs closer to 19%.
CEO Dara Khosrowshahi took over in 2017 after a turbulent founding era under Kalanick. His mandate was to stabilize culture, improve driver relations, and chart a path toward profitability.
Khosrowshahi's Expedia background gave Uber an operator experienced with global travel marketplaces. The transformation from startup culture to disciplined capital allocation took several years.
Uber's competitive moat is its network density. More riders attract more drivers, which shortens wait times, which attracts more riders. That flywheel is nearly impossible to replicate at global scale.
Uber One is the company's subscription membership that bundles discounts across both rides and food delivery. It increases cross-platform engagement and reduces churn on both sides of the marketplace.
Lyft is the domestic U.S. competitor in rideshare, but it lacks Uber's international footprint and delivery operation. DoorDash competes aggressively in food delivery but has no rideshare business.
Autonomous vehicles are a long-term wildcard. Uber has partnered with AV companies rather than building its own fleet, positioning itself as a distribution layer regardless of who provides the self-driving technology.
Uber does not pay a dividend. As a growth stage company building global scale, it prioritizes investing in platform density, new markets, and adjacent services over returning cash to shareholders.
The freight segment connects commercial shippers with carriers through digital brokerage. It is a small portion of revenue today, but addresses a far larger logistics market.
Uber's GAAP earnings can be volatile because the company holds equity stakes in firms like Didi and Aurora. Fair value adjustments on those positions move the reported line significantly each quarter.
That volatility is why operational metrics, trips, gross bookings, take rate matter far more than GAAP net income when evaluating Uber's underlying business health.
For long-term investors, the question is whether Uber can sustain take rate expansion as competition intensifies and whether global scale translates to durable free cash flow.
That's the Uber company chapter. Powerful network effects, global reach, and a journey from disruptor to disciplined operator well underway.
Now that we have the foundation, let's get into how the latest quarter played out.
Into the numbers.
Uber's Q1 2026 headline EPS showed a large GAAP miss, but the number is misleading. The shortfall came from mark-to-market losses on Uber's equity investment portfolio, not operations. Gross bookings grew double digits, adjusted EBITDA expanded, and the core platform is compounding. Look past the GAAP line, and Uber delivered another operationally strong quarter. This is Charged Alpha. I'm Hudson.
And I'm Lana. Uber Technologies operates the world's largest ride-hailing and food delivery platform, connecting riders, drivers, and restaurants across 70-plus countries and 10,000 cities. Founded in 2009, Uber generates revenue through three segments: mobility, ride-hailing, the core business; delivery, Uber Eats food and grocery; and freight, connecting shippers with carriers. The platform had approximately 170 million monthly active consumers as of recent quarters, Market cap is approximately $163 billion.
CEO Dara Khosrowshahi has led Uber since 2017, having replaced founder Travis Kalanick during a period of governance and culture crisis. Khosrowshahi came from Expedia, where he ran a global travel marketplace, and has driven Uber's transformation from a growth-at-any-cost company to one focused on margin discipline, operating leverage, and free cash flow. 2023 was Uber's first full year of operating profitability.
Starting with Uber's financials, Q1 2026 GAAP EPS showed a significant miss driven by mark-to-market losses on equity investments, including Didi, Grab, and Aurora. These are non-cash unrealized losses tied to equity price movements, not operating performance. Adjusted EBITDA, excluding investment marks, showed continued growth year over year.
Gross bookings, the total dollar value of trips and delivery orders flowing through the platform, is the operational metric that matters for Uber. Gross bookings grew double digits year over year, reflecting platform expansion across both mobility and delivery. Revenue, which is Uber's take rate applied to gross bookings, grew at a similar pace as fixed costs are spread over a larger base.
The mobility segment is Uber's most profitable business. Ride-hailing generates take rates approaching 28% of gross bookings, with driver incentive optimization steadily expanding margins. Uber One, bundling rides and eats discounts, expands cross-product engagement and reduces churn, creating a flywheel that single-segment competitors cannot replicate.
The delivery segment operates Uber Eats across hundreds of cities globally. Delivery take rates near 19% are expanding as order volume creates operating leverage. Grocery and convenience delivery adds non-restaurant verticals that improve consumer stickiness. Delivery profitability has improved materially as Uber pulled back from loss-generating markets and focused on density, where unit economics are positive.
Uber carries approximately $7 billion in cash against roughly $9 billion in long-term debt. Free cash flow has improved significantly as operating profitability scaled. Uber now converts adjusted EBITDA into real cash at rates supporting buybacks and platform investment. The equity investment portfolio creates GAAP volatility while representing optionality in autonomous and global platform companies.
Management Q2 2026 guidance called for gross bookings growth in the mid-teens % range, with adjusted EBITDA expansion year over year. The guidance tone was constructive, despite the GAAP headline. Khosrowshahi's team has consistently delivered against adjusted EBITDA targets, and the market has learned to evaluate Uber on operational metrics.
The analyst community's reaction to Uber's Q1 result focuses on the operational beat, not the GAAP miss. Analysts who cover Uber model on gross bookings growth and adjusted EBITDA, not GAAP EPS, and a mid-teens gross bookings beat with EBITDA expansion is a constructive outcome. Price target upgrades are likely as the compounding platform trajectory becomes more visible.
The constructive analyst view centers on Uber's network effect advantage. More riders attract more drivers, which reduces wait times and attracts more riders. A self-reinforcing platform density flywheel that smaller competitors cannot overcome at scale. Uber's global footprint in 70-plus countries creates competitive moats in individual markets that are nearly impossible to replicate from scratch, as a competitor would need both a rider and driver network simultaneously.
The autonomous vehicle debate is a key analyst discussion point. Companies like Waymo and Tesla are developing autonomous ride-hailing systems that could theoretically disintermediate Uber's driver supply model. The bullish counterargument is that Uber's platform, brand, and demand aggregation make it the natural distribution channel for autonomous miles. Waymo already operates on Uber's platform in some markets, and autonomous vehicles may expand the addressable market rather than threaten it.
Advertising revenue is an emerging Uber bull thesis. Uber's platform sees hundreds of millions of consumer touchpoints per month: trips, delivery orders, app opens. The company has begun monetizing this attention through in-app advertising, sponsored placements, and restaurant promotion products. Analysts who model advertising as a high-margin revenue layer on top of the existing platform see significant upside to EBITDA margins as the ad product scales.
The bear argument centers on regulatory and labor cost risk. Multiple jurisdictions have challenged Uber's driver classification model, treating drivers as independent contractors rather than employees. Court rulings that reclassify drivers could materially increase Uber's labor cost structure, reducing take rates and compressing margins. The regulatory environment for gig economy platforms remains active globally, creating an unquantified ongoing liability.
The bull case for Uber starts with operating leverage on a compounding gross bookings base. As gross bookings grow double digits on a $40+ billion base, fixed platform costs become a smaller fraction of revenue. Adjusted EBITDA margins have expanded from low single digits toward mid-teens, and bulls model further expansion as the platform reaches critical density in more markets globally.
Uber One is the flywheel accelerant. Subscribers using both mobility and delivery spend more, order more frequently, and churn less than single-product users. As Uber One penetration grows across 170 million monthly active consumers, revenue quality improves, creating predictable recurring streams that command premium valuation multiples.
Autonomous vehicle optionality is the long-duration bull option. If autonomous ride-hailing scales commercially, Uber's demand aggregation platform becomes more valuable, not less. The company collects demand regardless of whether a human or autonomous vehicle fulfills the trip. Bulls model Uber as the distribution layer for the autonomous economy, with driver costs declining and margin expanding structurally.
The bear case for Uber leads with driver reclassification risk. If courts or regulators require Uber to treat drivers as employees with benefits and payroll taxes, the mobility cost structure could increase materially. The California AB5 legal battle and similar actions in the UK and Europe illustrate that this risk is ongoing and unresolved. A large adverse ruling would require significant business model restructuring.
Take rate compression is the second bear concern. Driver incentives, competition from Lyft, and regulation can compress the percentage Uber keeps from each transaction. If take rates erode as regional alternatives compete for driver supply, gross bookings growth may not translate to equivalent revenue growth, compressing the fundamental driver of the operating leverage thesis.
Lyft competition remains relevant in North American ride-hailing. Although Lyft has lost market share, it remains a meaningful alternative for riders and drivers in major U.S. cities. Driver incentive competition limits Uber's ability to reduce subsidies without affecting supply quality, keeping competitive pressure persistent in the structural duopoly.
Gap profitability is the near-term bear anchor. Uber's equity portfolio will continue generating Gap EPS volatility tied to Didi, Grab, and other holdings. Investors using Gap EPS will see headline misses in markdown quarters. The disconnect between Gap reporting and operational performance creates communication complexity that can weigh on the stock.
Lyft is Uber's most direct peer in North American ride-hailing. Lyft operates exclusively in ride-hailing without delivery or freight, making it a purer but narrower competitor. Lyft's discount valuation reflects its smaller scale, no international exposure, and absence of the cross-segment network effects that Uber One creates. Lyft's operational improvement has stabilized the business, but not closed the competitive gap.
DoorDash competes with Uber Eats in U.S. food delivery. DoorDash holds the larger domestic restaurant delivery market share, while Uber Eats has broader global reach and the advantage of a bundled mobility platform. The two are direct competitors for restaurant partnerships and courier supply in most major U.S. markets, making DoorDash the most relevant peer for Uber's delivery segment.
Grab Holdings is the Uber parallel in Southeast Asia, a super app offering ride-hailing, food delivery, and financial services. Grab's growth illustrates what Uber's global platform could achieve in markets with lower penetration. Uber's equity stake in Grab creates financial exposure and strategic insight into the fastest-growing ride-hailing geography globally.
On valuation, Uber is priced on adjusted EBITDA multiples rather than GAAP earnings given the investment portfolio distortion. The market values Uber's platform at a premium to Lyft and DoorDash individually, reflecting cross-segment network effects and global scale neither peer possesses. Bulls modeling EBITDA margins toward 20% see significant valuation upside from current levels.
Uber's options market activity heading into Q1 2026 earnings was elevated, reflecting uncertainty about how the equity investment portfolio would impact GAAP results. Pre-earnings positioning was skewed toward puts, anticipating negative gap surprises. The gap heat miss was larger than expected, but the operational beat partially offset the bearish setup.
Post-earnings implied volatility compressed after the event resolved. Uber's options market activity showed a split reaction. Investors who read the adjusted metrics positively versus those who reacted to the gap headline. In the sessions following earnings, call buying on the gross bookings growth theme took precedence as the operational narrative became the dominant framing.
Insider activity at Uber reflects CEO Dara Khosrowshahi's established tenure. Planned stock dispositions under scheduled plan transactions are the primary filing pattern. Khosrowshahi has held significant equity through Uber's profitable transformation, and the absence of large block sales reflects confidence in the operating leverage story. No notable open market purchases have been reported.
The combined read from options and insider data is cautiously constructive. Pre-earnings elevated implied volatility reflected genuine gap uncertainty that the operational beat partially resolved. Insider activity follows standard plan schedules without conviction signals in either direction. For Uber, the investment thesis turns on gross bookings compounding and EBITDA margin expansion, and Q1 2026 operational results supported both.
Uber's Q1 2026 GAAP EPS miss reflects non-cash equity investment marks, not operational deterioration. Gross bookings grew double digits and adjusted EBITDA expanded. The platform is compounding on a large base with improving margin quality.
Bottom line, ignore the gap headline. The network flywheel is intact, Uber One is expanding cross-product engagement, and the operating leverage story has years to run. The autonomous vehicle question is the long-duration option on top of an already compounding platform.
Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.